Hi everyone, it's Alex here at Session Capital Research. Welcome to our Growth Investor Pro weekly webinar for Thursday, 24th of April. Welcome everybody, particularly those of you who are recent joiners to the service. Hope you're finding your way around. If not, do reach out in chat or respond in comments to the daily notes you'll see published each day a couple of hours after the close. Okay, so market pretty strong last couple of days. Remarkable reversal thus far in April in the Nasdaq. At least S&P is down a bit still for the month. I want to look through just our normal run through of high level market tests. So the S&P, the Nasdaq, the Dow. Let's look at the VIX 10-year yield, TLT for bonds. Let's look at Bitcoin, and let's look at semiconductors, SOXX, Bitcoin and semiconductors as risk canaries, really, just to see at the sort of bleeding edge of risk appetite where things stand. Single stock names, I want to look at some charts. I've not had a chance to see the Google or the Intel earnings yet. Google earnings response looks pretty good, Intel not. But let's look at the charts. And per a great question in chat from Paloma earlier, which is, if we get back to stock picking, here's four names. What do you think? Broadcom, Dell, Palantir. So we'll look at those as well. Again, just on a charts basis. Now, as always, we run these things on a live and open mic basis. So once I've done the disclaimer in a moment, we'll open mics. If you have questions, points, comments, anything at all on the way through, please do open your mic and shout into the system, or use the question or the comment function here in the webinar software. I'll pause at various points for questions, but if you have a burning issue, please do just shout. Okay, let's get on and do our disclaimer, which is on your screen now. So disclaimer, this webinar is intended for US recipients only, and in particular is not directed at nor intended to be relied upon by any UK recipients. Any information or analysis in this webinar is not an offer to sell or a solicitation and offer to buy any securities. Nothing in the webinar is intended to be investment advice, and nor should it be relied upon to make investment decisions. Session Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stocks, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as of the webinar's date of transmission and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of Session Capital Research. Session Capital Research values both its independence and transparency and does not believe this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, before we get started, folks, just one comment. A number of you are signed up as free readers on our website, not the Seeking Alpha site, but our own sessioncapitalresearch.com website. There's a daily market overview note that's published on there, which is a pay note. It's part of our premium inner circle service, but we make it available to a discounted service called Market Insight. That service, Market Insight, is going to close to new members on the 1st of May. So if you want to get daily market overview notes, if you're interested in doing that, sign up before the end of April. I'll put a link on the YouTube recording, and I'll include a 25% discount as you're already subscribers to another Session service. So if that's something you're interested in, sign up before the end of April, because after that, that service will be closed to new members. The more expensive services will be available, of course, but that particular one, we're going to shutter to new members. Okay, let's get on. Right, market overview. Let's look at our old friend, the S&P. Wait 1 second. Okay, here we go. So, I mean, the remarkable candle here is April. It was remarkable last week when it was plumbing the depths, and it's remarkable this week when it's still a little bit below where it opened April, but it opened the month in 557-ish, and thus far we're at around 546, 547. So, so far we've just gone all the way down here, retested the highs of 21, 22, bounced. We're now sat right at the March lows. Now, March, as I said, I've said multiple times, was just a normal sort of correction. The S&P couldn't break through this 100% extension of that wave 1 place to that wave 2. It tried it in December, January, February failed, and so you're always going to get some sort of corrective move thereafter before, in normal markets, a new attempt to break that level again. What we got was a normal sell-off in March, and then obviously a big market tantrum in April, caused, as we know, by the I would say the uncertainty of trade policy. I've said many times that I think there's nothing inherently anti-market about a tariff-based trade policy. All countries have tariffs with plenty of other countries, and there's nothing particularly market unfriendly about raising tariffs somewhat from the current environment. But markets hate uncertainty, and so the market reaction has been very simply to the instability of trade policy, I would say poor engagement with trading partners to reach a conclusion, and the general standoff between the US and its larger trading partners. Markets don't like that. Now, the fact that the market has recovered so much, I wonder how this will play out. What that's telling you is it's telling you that the market thinks that the administration is going to fold. And by fold, I don't mean go back to the previous regime. What I mean by fold is put in place a simple 10, maybe 20% tariff regime with its major trading partners in order to claim, in essence, a political win. Don't forget the administration campaigned on this issue. It's a core issue for them. They were elected on it. They will consider it that they have a mandate to do this. But if they drop the punitive trade deficit-based calculations and we get some more conventional engagement with trading partners and the adoption of any tariff regime that the administration can credibly claim as a political win and the satisfaction of their electoral promises, then I think the market's reaction will be correct, and I would imagine the market will continue on up. If, on the other hand, we get to the end of the 90-day pause period and either the administration rolls back and tries to put in place those more punitive numbers, or perhaps the larger trade partners, obviously being China, the EU, are the two ones that really matter, have decided to just disengage, not negotiate these things at all, then I think the market will conclude that it got too excited too soon and sell off again. So I think the markets always swing too much in one direction or another. So it's a positive thing that the bond market in particular, that the kings of Wall Street have put pressure on the administration. It's a positive thing for the market. It's not a political statement. It's just our job here is to analyze the market. So the market has spoken. The market has explained to the administration what it thinks is good and what it thinks is bad. The administration appears to have responded, and the markets rewarded that by risk asset prices going up. Whether this is a premature move or not, I'm not sure. So I personally would treat this as a sort of a September 2020 type of time, which is, look, don't ignore it. Don't ignore the fact the market's going up, because the market's going up, and the best evidence of price is price. So in the third and fourth quarter of 2020, a lot of people lost a lot of money by deciding that, the fast recovery out of the March lows that year must be unsustainable, because that was simply a short covering rally, fueled by amphetamines from the Fed, and the market couldn't possibly continue to go up because, obviously it couldn't, because look at the state of the economy, and so on. And they were wrong. They were sort of wrong for the right reasons, which is this market makes no sense. It didn't matter. It kept going up, and people got really badly burned if they were short the S&P or the NASDAQ or major stocks through September through December 2020. And this feels a bit like that time to me, which is we can all construct every sort of reason why this market strength will give way, and the news will overwhelm it. and we'll get a snap back to the downside. I'm not saying all the way back down here, but certainly a retracement. But that isn't necessarily going to happen. And so more than ever, I would say we have to be really careful to watch just price and volume, and try and ignore the news. Because although the market is reacting to the news more so than it normally does, the news is just one of a number of inputs. And if market moving investors have decided that, well, this thing's going back up, it just is, then it just is. And our job is not to question why, our job is to follow the trend, be it up or down. So I think that, okay, for anyone who's long, it's good. It's good to see this bounce and this move back up. It's really tricky now. Easy to lose faith, easy to sort of take short-term profits, easy to decide to hedge, all of that. Harder, I think, to sit tight and see if the market keeps going up because of all the reasons that it shouldn't, in inverted commas. But for now, up is up. So I think wits about us. Let's look at the Nasdaq. So this is on the weekly. Let's look at the monthly actually, just briefly. The Nasdaq is green for the month, only just, but it's green for the month. So this is the Nasdaq monthly candle for April. Huge. So opened at around 467, dived all the way down to 402. We're now back to just slightly above where it opened. If we go back to our normal weekly chart for this, if I'd said 10 days ago that the Nasdaq was going to be green for April, then I think a lot of people would have been surprised. So again, watch price, not the news. So this is the weekly. We get a bounce right at the high that was struck in 21-22. And let's look at the volume here. Okay, now what always happens when a sell-off peters out, you'll see volume go to almost zero because the sell-off stops when there are no more sellers, obviously. What we don't see yet really is a sort of big, heavy, concerted amount of buying. So there's more volume here towards the end of March than there is down here at the lows. And so again, a little bit hesitant to think that the Nasdaq's just going to keep mooning. Even wherever you set the clock on this volume chart, you don't yet see really committed buying down here at the lows, which is what you'd expect to see if basically people were accumulating big time in the anticipation of the Nasdaq going up. Now that might happen, but it hasn't happened yet. I'll show you what that might look like. Here's SOXL. We don't cover it here, but look, if you set the volume clock starting here in early February, there's no volume on the way down. There's a bit of selling here when it collapses, but look at the huge volume spike down here. SOXL, this is a levered semiconductor fund, is back to 2022 bear market and 2020 COVID crisis levels, or was, a week or two ago. And look at the volume pickup. That's only since February. And if we put the volume chart at the all-time high there, again, look, the volume is absolutely peaking down here at the lows. And so in semiconductor, that says to me you've got a committed bunch of buyers that think this thing's really going to go up. In the Nasdaq, you don't quite see that yet, which I'm slightly surprised by, I must admit. But anyway, that's what the chart says. Dow was hit a bit harder these last couple of recovery weeks by United Health, which reported earnings that were poorly received. Again, if we look to see evidence of a big buying recovery, it's not really here. So not yet seeing big committed buys in the index ETFs. It's there in semiconductor for sure. Semiconductor is very badly beaten up. It's not really there, I don't think, yet in the big index ETFs. And that would rather suggest to me that so far this big bounce in the indices is more short covering than it is long-term investor buying. Now, I'm guessing here, but that's my instinct. Otherwise, where is the big volume spike down here? Where is the pouring in of new smart money to buy this low? It's not really happened yet. Now, That can be late. We saw in 2023, people weren't buying in January, they waited, they were buying in May at much higher levels because they'd missed the low. So perhaps that happens. But for now, just be a little bit circumspect about believing this thing is going to keep going up. And I would also be circumspect about it's going to retest the lows because of all the things that are happening outside the window. It's quite a tricky time right now in markets. Green is good for most people, but that doesn't mean it's easy. It's a slightly strange kind of green right now. Okay, let's also look at what's happening with bonds. So let's look at the 10-year yield. Now, I saw something on Twitter the other day to the effect of, well, how can you possibly trade bonds in this environment? They're all over the place. Well, my answer is they're not. They're just following standard patterns. So this is the 10-year yield. This is the low back in September 24. The Fed started to cut rates here. The market decided that was inflationary. So bonds fell. If bonds fall, bond yields go up. And so the yield moved from 3.6% in September 24 to a peak of 4.8% in January 25. Starts to fall. The new administration gets in, tells the market it's really committed to improving bond prices, meaning raising bond prices, yields dropping, and the market believes it. The market listens to messages about cost cuts, debt service, all of that, and sure enough, the 10-year starts to fall, and it bottoms on the 4th of April, just before, just right around Liberation Day, at around 3.8%. There's a brief rotation of equities into bonds, which is what causes that. And then the 10-year just moons. And it moons when the market is worried about a new trade regime that isn't particularly pro-market. And so what happens is bonds start selling off as well as equities. And the thing that really forced the administration's hand was not the equities market. It cares about that a bit, but what it really cares about is the bond market, because governments depend upon the bond market to exist. Almost all governments are levered. And without that leverage, they can't pay the bills, they can't pay salaries, they can't pay defense budgets, welfare budgets, can't pay for anything. If the US was suddenly to stop being able to service its debt, the economy would grind to a halt. So the pressure from the bond market, and in particular some major bond market participants, is what caused the administration to signal this backing off. Now again, look, anyone says that you can't trade this market, of course you can. Here's the peak. Here's a 1, 2, 3, 4, 5 wave down. And we posted this every day on our website, so this is not post hoc rationalization. We get a retrace, the yield moves up, that means bond prices are moving down, and it hits the 78.6 retrace of this move down here. So that's a really clean technical level to reject. It did, and then we're in a 1 down, 2 up. I think we're in a 3 down wave for the yield right now, which just means a wave 3 up for bonds. And this is a very tradable market. So we look at TLT, which we have as a pick in the service. It's down about 4% now on the pick, but it's held really steadily through this period. Volatility in TLT, it's there, but it's nothing as volatile as stocks have been. And I think that we are now climbing up the stairs in TLT. So from a low of around 85 on Friday the 11th, we put a 1 on, 2 down, and I think we're in a 3 up right now. So I believe TLT will keep climbing. It pays around a 4% dividend as well. So it does in fact pay you to own it. Lastly, let's look at Bitcoin and SOXX. So SOXX first. The reason to use this is because semiconductors are the bleeding edge of technology stocks, and so they're often a leading indicator of what's to come, be that good or bad. Well, this is what happened. Peak here of July, in 10th of July. A, B, initially an A, B, C down like this, flat with the A, and then drops all the way down to here, and then bounces hard. SOXX bounces at 148. Let's adjust this a little bit. Wave 1 high, 186. This is following the buy everything tweet from the White House. And then a wave 2 retrace that hovers around that 61.8. That's a righteous wave 2 low, and then set off in what I think is a wave 3 now. So we'll see, but 182, so it's down slightly. So Intel, I think, is probably dragged this down a bit, down slightly after the close. So I think this is in a wave 3 up, but we'll see. If it can't break that 185 level, then it's going to turn down again. So if it can't make a new high up and over that, by everything tweak day, then it's going to give some ground up. Lastly, before we'll stop for some questions, Bitcoin's doing great. So the important thing here is less wave count and more where it sits in relation to its moving averages. This light blue line here is a 50-day moving average, and this purple line is a 200-day moving average. Now, first of all, notice both of them are pointing up. That's very bullish. That's not true for the equity indices or most stocks, pointing up. Secondly, you can see that in recent days, Bitcoin looked like it was going to move up and hold over its 50-day, which it did, and then launched to try and hit the 200. On Monday, hit the 200, bounced off. On Tuesday, pushed all the way up through it, and has held over that since. So I think Bitcoin is in good shape, and the 200-day right now is around 88, 89,000. If it can hold over that 200-day and keep rising, I think Bitcoin can do really well. So Bitcoin's looking pretty bullish. Semiconductors are looking pretty bullish. That generally is a good leading indicator of the rest of the market. And again, I think it's a really tricky time. One has to expect the unexpected, expect volatility, expect that a single tweet can take a lot of the sales out of the market or turbo fuel it upwards. You just have to accept a bit more volatility at the moment than is typical. And again, I think suspending judgment on what, inverted commas, should happen in the market is critical. And for anyone who's doing this back in 2020, I would point to that Q3, Q4 2020 period when the market appeared to be defying gravity, and anyone who thought they knew better than the market started to hedge and short and whatnot, and just ended up poorer as a result as the market humbled them. So I think this is a tricky time. Right, before we do single stocks, why don't we stop for some questions? So who have we got? I think Paloma, you're on. Yeah, Paloma, you're on. How you doing? Okay, I think we lost Paloma for now. Hey, Prasad, do you want to go? Hang on, that's entirely my fault. I failed to turn microphones on. 1 second. Right, let's try again. Paloma, you were first. Try again. Okay, Prasad.
Hi, you silenced.
Yeah. No, that's sorry. I had silence different.
Silenced everybody.
Yeah, exactly. I thought only my voice shall be heard this evening.
No, I was just I missed. I joined a little bit late, and I missed the first part that you were saying that your daily email will no longer be available. Is that the one that you send every day with you review every single?
Yeah. No, if you anyone who's an inner circle member will still get it. What I was saying is we've a lot of free readers on the website, and at the moment we sell a low priced service with that market note and some earnings reports, and we're ending that low price service at the end of April. So I was just saying that anybody who wants to get the market report, sign up now. I'll put a link in the video to this. It'll be 25% discount. You already get in a circle, Paloma, so you don't need to do this. But
Okay,
anyone
fine.
wants it. So
Okay.
just a few. We're going to shutter the service, so anyone wants it, shutter it to new members. So anyone that wants it, sign up soon. I'll put a link in the YouTube recording.
Okay, and then Bitcoin, it was a nightmare. I struggled because I couldn't buy the IBIT through my European brokers, so I had to do a transfer, and it took actually it arrived today. So ha ha ha. I was going to buy at 86, and now it's at 93. So I'm pissed off, not because the market. I mean, yeah, because I missed the rally. And my question is, should I be waiting for a kind of a come down? Would it come down a little bit? Do you think, or we're just heading to the moon from here?
I tell you what. I mean, I bought more IBIT today. I bought one. I think I've got 5 units at the moment. I bought 1 unit today.
Okay.
Because Yeah, I think it might come back and retest that 200 day, which is currently around 88, 89. It might do that, but that's only if say it does. I think it will hold over it, and that's only what a few single-digit percentage point drop. So yeah, I might do that, but I think my own personal views. I think the upside is pretty good here. So I don't mind buying on the way up with this thing. Uh, so I mean, as you know, I bought some down here, sold it below the 200 day just to take profits. As
Yeah.
it happened, it rocketed up through the 200 days, so I started buying again up here somewhere, and I added a bit today because I thought, well, I want to build a bigger stake than I've got, and I don't mind if I'm buying on the way up. So, I mean, I don't know, but that's what I decided to do. Um, I will see. It surprises me that I mean, Bitcoin's supposed to be easy. I'm surprised it takes so long to use these sort of native Bitcoin exchanges, to be honest. And I saw someone say in chat that they'd given up trying to authenticate their Kraken account, and
Well,
they just
I did it through Kraken actually at the end.
yeah,
Yeah, it was the one of the cheapest, and I managed to open the account quite easily. And the only thing it was D+4, so I had to wait till today for the money to arrive. But I
right,
was going to buy IBIT ETFs, and it was completely I could only buy them in euros, and I didn't want to buy them in euros because I have lots of dollars. So I said, what's the point of changing the dollar into euro at these levels, as we spoke on
yeah,
the
yeah,
last call. So I said, I'll use my dollars, and it was completely impossible. So I just said, okay, I'll just buy the Bitcoin directly, not the ETF.
yeah,
So I will buy it tomorrow. The
yeah.
other thing is I'm pretty underweight equities. I'm sitting on a quite substantial pile of cash, and this rally has caught me a little bit by surprise. Um, and I'm kind of all of those things you mentioned at the beginning of the call. It's like, for me, there is still a concern that if Trump doesn't really start moving on all these tariff deals, I think that the market is still just sitting on a very fine line.
I agree. So I'll tell you what again, just tell you what I'm doing, which is in my trading account where I can go long and short really easily. I'm heavily net long, um, and that's going well. Um, in my long-term accounts, I went to cash and bonds in I can't remember when, but February or something. And I own in there. I've got a few energy stocks, Lockheed Martin, bits and pieces, but not much. It's still heavily cash allocated, and I'm sort of going slow twitch on that because I don't mind if I miss part of the rally in those long-term accounts. They're retirement accounts that I can't cash out for 20 odd years anyway, probably. And so I'd rather I don't mind in those accounts going slower. And so what I'm waiting for in those accounts is I'm going to look for a bunch of stocks. One of them you mentioned, Broadcom might be one of them, to see when they start to clear their 200 days. Yeah, I thought so. Broadcom did it today. Okay. I'm thinking about adding over the 200 days in some of these better names that have been beaten up, and then
Hmm.
bring a stop, a little bit below the 200 day. Because if, I mean, let's take China, for example, which is obviously relevant to all these chip stocks. The US is saying, well, it's going great with China, and China's going, we haven't even spoken to them. So one of those accounts is true, or perhaps neither of them is true. I don't know, and there's no way of knowing what is true. Um, and so any uh, any collapse in where the market thinks the China tariff is going, obviously is going to hit Broadcom, Nvidia, all these. So I figure, well, don't try and buy for the long term below the 200 day because crazy stuff always happens below there, as we've seen. Buy above. This is just my own logic. I'm not saying what anyone else should do. Buy above the 200 day. Okay, you won't catch the low, but that's a sort of a less risky place to buy, and put a stop a little bit below the 200. So Broadcom is high on my list. Um,
Hmm.
it's almost it clipped the 50-day today by the look of it. So I mean, if it got over the 50-day and the 200-day, tomorrow, so it looks like Intel earnings reaction wasn't brilliant. So I have to see what that does to chip stocks tomorrow. But if it holds over that, I'll probably pick up some Broadcom. Not huge allocation, but just start. Where's that? Where's Apple? See, Apple's not really close to its 200-day yet. Um, so for me, I would go through and go, right, which are the absolute best companies? Which are the Buffett quality companies? Apple, Google, Microsoft, all these buy over the 200. Or maybe here's Google. So it's right at the 50-day now. Post market 167. It's right at the 50-day. So maybe buy over the 50, stop below the 50, sell at the 200 if it starts climbing, and just be really careful. But over the 200, I would feel better about adding the single stock names. So those are my retirement accounts. The trading accounts, I'm more aggressive with because I can always hedge and short if I need to. Whereas that's really, really difficult. It's sort of possible in the retirement accounts, but it's really hard. So I rather, when things get difficult in those accounts, I'd rather just go to cash rather than try and hedge and short and whatnot.
Yeah. Yeah. No, I bought the SOXX after our last call at 165.
Oh, good. Well done. That's gone well.
Good one. Yeah. Very happy.
That's gone well.
And
Yep.
and I put a stop loss at minus 10%. And actually, tomorrow I'm going to raise the stop because
Yeah.
it's much higher. So I'm pretty happy about that one. But I do want to start doing some stock picking again.
Yeah. Well, I think it's a great time. It's never a great time when the market's on fire, on fire in a good way because everything's expensive. But right now, yeah, you've got top quality companies that have sold off hard. I mean, Netflix at an all-time high. So there's plenty of upside, I think, in some of these better names. And so for me, it's go and look at the companies that are the best businesses. Are the ones that you're happy to own. ASML would be another one, I would say. Yeah. See, ASML, I bought down here and I sold it quickly for a quick gain because it was just bouncing around a bit. But yeah, if that starts to climb up, I'd rather buy ASML a bit higher than here because I would consider it to be safer. But that would be on the list for me. What else? I'm just looking through. Where's Microsoft? So Microsoft's at the 50-day. So you could think
Yeah.
about buying it over the 50 days, stop below it. It's not quite there yet. Nvidia, I'm not sure about Nvidia to be honest.
No, no,
Uh,
I'm too. I got too burnt with Nvidia.
yeah, Palantir.
I
Well,
like I like Palantir and I like ARM. I miss the ARM trade. I was pissed off with myself, but I miss the ARM trade.
I tell you what, look at Palantir. I tell you what one could do with Palantir is buy it with a stop below the 50. Right, so what's it at 108 now? Put a stop in the high 80s or something. You know, it's still a good chunk of change below its all-time high. That's probably a wave 4 low right there. So I'll tell you what, let's have a live look at Palantir. So probably, let's just do the extension here. So 303. Okay, so I think we could say, forget the valuation multiple, forget any of that, but I think we could say a price target of, yeah, somewhere between 125 and 148, say, on Palantir from the current 108, and a stop at, I don't know, 87, 88. So let's say you got $20 down. So risk reward isn't brilliant, right? So $20 down, let's say, to a sensible stop, minimum sort of viable upside as a move is like $20. You might get you might get $40. So I'd say at best you sort of 2 to 1 upside to downside. So that's not a screaming buy personally for me in Palantir, but that's because you're buying a wave, a wave 5, not a wave 3. So it looks okay, not brilliant. What's Qualcomm doing? This is very few individual stocks so far that have got up and over any meaningful moving average.
Mm.
What's that doing? 6 still below, 50 just crossed the 200, and this is why one has that feeling of don't pile in right now. I'll tell you what is doing well. Zscaler. There you go, up and over the 50. It's held up really well. It didn't really drop below the 200 for more than 6 days. So that's in good shape. Zscaler is worth thinking about, I would say. Yeah, Robinhood over the 50. So there's a few, but there's not many single stocks where, again, if I apply my long-term filter of go and buy a Warren Buffett quality company over the 200-day with a stop a bit below the 200, there's still not many there. They're still quite badly beaten up. They've bottomed, they've rallied, but is this a safe time to buy those stocks? It's still a bit hairy, I would say. Whereas if you're trading and you can hedge and short and just react a bit more quickly, then the gains at the moment have been terrific, obviously.
Hmm.
That's my
And
view.
what about ARM? Do you still have ARM, or you sold it?
No, I don't own it at the moment, and that's why. Um, Still down here in the doldrums. Richard, aka Hermit, made a brilliant call on this, and she just phoned me up and went, "We need to have this as a pick," and he's up 15% in about 3 days or something on this. That's all
Wow.
him. That's all him, not me. Nothing to do with me. So that was a
Yeah.
fantastic call, which I should have bought and didn't. That shows what I know. But this is one. This is one that I would like to put in that retirement account. But I'm probably just going to wait a bit. I'd rather buy a bit higher for those long-term accounts and be over the moving averages because it gives me a sensible stock. So if you buy it now, what's your stop? 75, and you're buying at 112. Whereas if you buy it over the 50 or over the 200, you've got a sensible stop a bit below there. So for a risk reward point of view, I feel like not quite yet. Whereas again, if you're trading, you can buy an index, and if it goes wrong, you can hedge it, you can short it, all of that. But the single stocks still look in a little bit of trouble to me. Or let me put it another way: they don't look like they're out of trouble yet, and nor should they be. If you look out the window, you've got a market bounce, an anticipation. It's almost like the market's saying, "Oh, this was a storm in a teacup. We're going to roll back to how we were," and we're not. Obviously, there will be a tariff regime put in place. It's not going to be popular with the US's major trading partners, and there will be a series of hissy fits around the world, and so that's going to be a bit difficult for markets here and there. So, for what it's worth, I think markets will recover. I think we're going to see new highs before any sort of proper bear market, but I don't think it's going to be straight up. I don't think it's going to be easy, and I don't think it's a market to chase. I think it's still a market to go, right, there's been a big setback for something or other, that's a dip to buy, rather than chase it on the way up. That's my best guess.
Okay. Where would you find all these guys? Broadcom, Palantir, ARM. Would they be in the QQQ?
Most of them, yeah.
Okay.
Yeah, most of them.
Okay. Super.
Okay. All right.
Thank,
Thanks,
thank you.
Paloma. Good
Hmm?
talking. Prasad, you're on.
Hi, Alex.
Hey, how you doing?
So my question is more on general, first thing I want to give you kudos to, how well you kind of, before this tariff thing, before the Liberation Day, you went all cash and went into bonds. Uh,
Well, I
so,
didn't. I didn't do. I'll give myself a pat on the back for doing it in my long-term account. I didn't do it in my trading account, and it was somewhat hedged, but not hedged enough. And Liberation Day definitely punched me in the teeth, um, and in particular because I was expecting a move up after Liberation Day. Reason market did a sort of a 1-2 setup into it, and the minute they came out and went 10% tariffs across the board, the market went yippee and went up 1%. And then then the tariff board of shame came out and stock started selling. And my view on that was, well, they can't possibly do that. That's not a policy. And, so we just have to wait that one out. So Yeah, it's worked out pretty well, but not without one or two moments.
Uh-huh. So, in one of the accounts, you went all cash, right? Like, what prompted you? Like, and you started that, you moved that sometime in March only, right? Early March or something, right? What prompted you to take that step?
Hang on, I'll tell you when I did it. I can't quite remember, to be honest. Hang on. I can't find it.
I think you closed down all the single stock picks and just said, like, you
Oh, here we
were
go. Yeah,
TLT.
March the 3rd. March the 3rd. I don't know. I can't remember. Hang on. Usually because I think, okay, well, what I think is going to happen keeps not happening, and if I'm, we can all be wrong every now and then, but if you're consistently wrong, it means it means your frame of analysis is incorrect. You go March 3rd, so it would have been around the open or the close then.
Mm.
Yeah. I can't remember, to be honest, but I can't remember what the specific catalyst was, but it would have been because I had a queasy feeling, and because I know what it was. Because I think I tried a couple of sort of swing long trades which kept breaking, and I just thought, well, these aren't working. This is too hard. In those accounts, it's really difficult to hedge or to short. It's sort of possible, but it's hard work, not very efficient. They're not margined accounts, so if you want to hedge, you've got to use up a lot of cash, blah blah blah. So I think I decided it was all too difficult and went to cash. And then, and what I've previously done wrong when I've done that is to get back in too quickly. And this one, I just thought, this is crazy time. I'm just going to sit this out. And I will say, the other reason that I did that is because I decided to run a good portion, not all, but a good portion of my retirement accounts according to the Signal Flow AI service that we run, because it's a slow twitch model. It doesn't flip from risk on to risk off every 10 minutes. It's generally underreactive, and so it's not great for day trading, but that's not its point. The model's designed to outperform buy and hold over the long term, which in back testing and also in the live trading it's done since it launched last year. It achieved that. And so my plan on the retirement accounts is to go substantially long when our signal flow model goes long. And so that was a fairly recent launch, that service. The back testing, going back 15 odd years, is fabulous, but back testing is back testing. And so one of the things I've been doing is watching how it performs through this sort of crazy time to see how it deals with very complicated reality. The answer is it's been superb. It went in the S&P, it went risk off in early March, might have been the 3rd of March, maybe that was the catalyst. And NASDAQ, I think it went risk off in, I'm going to say the 26th of February, something like that. And so in the QQQ, let me just check what I've said is correct. Hold on one second. I'm sure it went off. 1 second. 28th of February. So this is why AI is such a powerful tool if you do it right. Because it doesn't get all excited like humans. So it went risk off on Friday the 28th of February in the QQQ. So it went to cash at 508 on the QQQ, and it missed basically a 20% drop. I mean, that's remarkable. So for long-term accounts, when that model flips back long, I'll probably start building up then as well. So I pay a lot of attention to that model. It's a machine, it's not a person, but therefore, it's unemotional. It doesn't know what a tariff is. It doesn't know what valuation is. It doesn't know who Peter Navarro is. It doesn't know any of these things. It just looks at price patterns, and it's been superb so far. So that's the other factor for me.
So basically, the reason it turned it off to risk off mode is like, did it see a lot of institutional selling during that time?
It doesn't know anything about that. It saw an unstable price pattern, and it generally associates high volatility with bearish markets. And so it will have seen, if you like, weak relative strength, not RSI, but just small r, small s, weak relative strength in the QQQ, and it will have gone, I don't much like this, I'm getting out. Now, it also, so far, has not gone back to risk on, and the reason for that is it doesn't really buy spike dips. If you look at all of its back testing and live trading history, it waits for things to calm down. So, if you're following that model blow for blow right now, it's easy to get frustrated and go, oh, well, come on, you could have bought the Nasdaq at 402 and look, it's at 468 now. But the model will say, well, hang on a minute, it was at 468 on 2 weeks ago on the Wednesday, and then it dumped to 427, and this isn't easy going. This is hard going. And this is what machines are great at. Machines are much better at saying, I don't much like this pattern, I'm going to stay away. Whereas humans will go, oh my God, I got to buy this dip. Oh, it's a big Greek candle, I'm going to buy that. Oh my God, it's red. That emotion gets in the way. And a machine doesn't feel like that. So what the model will be waiting for now is some price stability. And when it sees price stability over a period of time, then I would expect it to go, okay, risk on. So if you look at the back-tested history of its trading, it reacts a bit slowly. So it won't call a top to the day, and it didn't this time. So the actual top was the 19th of February. It called go to cash on the 28th of February. So about 8-9 days later, it hasn't called buy yet because it will be waiting for this to settle down. But I'm pretty confident that once this settles down and we just get a bit less craziness, look at all the gaps. This is QQQ, right? And look at all the gaps, big gaps, crazy price action. This isn't characteristic of a bullish market. This is a characteristic of a bear market rally, and we'll see how it turns out. But a machine will look at this and go, this is still difficult. I'm staying out of the way of this. So that's proving really good for us.
I see. So is it just like, if the volatility is very high, the machine tends to make it like it see it as a bear market, and is that the king?
It doesn't measure volatility. It measures price action, and it looks at the small r, small s relative strength of the thing it's measuring versus the thing's own history, or sometimes, depending on which implementation of the model we're talking about, sometimes relative to the S&P. So when I use the word volatility, I don't really mean the VIX. I mean crazy, just the ordinary meaning of the word, crazy price action. So look at crazy price action and go, I don't much fancy this. What I like is slow building bullish action. I believe that the model will say, I believe that means cash. Go from cash into risk on. And any sort of sharp drops or craziness like this, it will say, this is a bit crazy. I think I'll go risk off. So through all of this period, there's ups and downs, obviously, but there's no crazy up and down. Look, from September through to February, there's just normal ebbs and flows, not too crazy. So what the model looks for is, if crazy, go to cash. If crazy down or crazy up, don't like this, go to cash. If nice, smooth, then go into risk assets. And again, back testing is terrific. Just outperforms buy and hold by quite some way.
Got it. So I have subscribed to that service.
You have.
So I have.
Yeah.
So how do I use it? Like it's been saying long PSQ now, right?
Right. So you're in the long short version of the service. So I'll tell you how I'm using it, which is very simple. I'm long PSQ. So I use that in my trading account. So in that trading account, I'm long TQQQ, I'm long SOXL, I'm long UPRO. I've got all these long 3 times levered ETFs. But in there, I've got a sizable PSQ allocation. And it's down about, I think, 7 points now. But I'd already cashed. I didn't follow the model exactly. When I was showing some nice gains in PSQ, thanks to the model, I actually took those gains and used the profit to buy additional long um, long positions, which isn't exactly what the model does. But I've just left that hedge in there because if the model flips long, then what I'll do is I'll sell the PSQ. If I'm selling at a loss, that's fine. And I'll take the capital that I harvest from that and I'll roll that back into whatever long instrument it says. And the reason I'm doing that is because I trust its trading, I trust its back testing. And that's because it's Jay's model, it's not mine. But Jay and I spent a lot of time, um, I would say, defining how that service would work. I'm not a statistician, but I have reasonable understanding of how the model thinks and why it thinks what it thinks. And I've also just watched its decisions against mine, and it's very often a better trader than I am. And interestingly, it's very often a better trader than Jay is, and Jay is a pretty good trader, and Jay wrote it. So you see this often with quantitative models, which is they very often, the good ones, outperform their creators. And that's because they're doing their job, right? They're not getting buffeted around by things in the world, news, noise, all of that. They're just focused on signal. Hence the name.
Got it. Yeah. So in that, right now it's showing long PSQ, right? So, but does it also show like at various times long, QQQ, long T triple Q
It,
or long SPY kind
it
of a
will
thing?
do, yeah. The service you're in, long, short index, it
Mhm.
chooses between five things, right? Cash, PSQ, which is one time short Nasdaq, SH, which is one times short S&P, SPY, one times long S&P, and QQQ, one times long Nasdaq, and it'll flip between those five um, choices. So at some point, it will flip from long PSQ to something else. What that is, I don't know. My guess is it will go cash and then it will go long something else. Would be my guess if the market continues to settle down. Um, but a couple of times I've sort of looked at it and gone, I don't know why that hasn't got. So, for instance, on the buy everything tweet day, the 9th, I thought, well, okay, let's see how it does. My instinct, because I'm a human and I'm fearful and greedy, my instinct is cut that short, and buy everything going long because the president of the United States has told me to buy everything. Um, but I held the short, and then a few days later, it generated a really nice profit for me, which I sold, took the gains, and used to buy some long positions, and then re-hedged at the end of that day. Which again is not exactly how the model works, but how I chose to use it. So I have a high level of confidence in it, and anything can be wrong, any model can be wrong, the world can change, anything can change. But I have a high level of confidence in it, and it's I don't run all my capital using it, but I run a substantial amount using it precisely because I feel like I can outsource the decision to a very calm robot, which so far, I mean, if I'd done exactly what it said to do during this downturn, I'd be richer than I am now. Right? Simple as that. Simple as that. And so, if it can do smart things in very crazy market environments, I think it's likely to continue to do well in calmer environments. So I rate it.
Got it. Got it. Yeah. But since it's right now saying PSQ, but long PSQ, but everybody is like, we all are thinking that, if any, it's the market has been beaten down and any kind of thing can lead us to a jump in pricing, right? Asset stocks, right? Uh, so if that is the case, like, the market is beaten down and we are expecting deals to happen and it's expecting it to go up. So, but model is saying long PSQ, that is short, short QQQ, right? Or short SPY. Uh, so given that, but you also mentioned that it takes a little bit of time. So it wants to see some more data to change the direction, I suppose, right?
Yeah, yeah,
So,
yeah. I mean, and also just look at the chart in front of you, the QQQ. Okay, so what you have here is okay, the QQQ today post market, it's just over the buy everything tweet day. Just okay. It's below the 50 day, and the 50 day is pointing down, and it's below the 200 day, and the 200 day is pointing down. That isn't a bullish setup. It's not. It might be that the Nasdaq moves, and if it does, well, good because I'm net long the Nasdaq. But that is not a bullish setup. So if you had no fear or greed, okay, if you knew nothing about anything and you looked at that chart and you said, is that bullish or bearish? You'd say that's a bearish setup. That's what you'd say.
mhm. Got it, got it. Okay, okay. Yeah, like I think I made a big mistake of like not cashing my positions. Like during the whole March time. Like seems like everybody kind of anticipated this tariffs coming up.
No, they didn't. They're just lying. No, they didn't. Of course they didn't.
Hmm. Yeah, at least I should have cut down all my margin and just be on the my cash stock holdings, right? It's not
The
like
number of people who've told me they've been absolutely blown out and destroyed by this market. Okay, so if you've been hit by the market, don't beat yourself up. It's been difficult. I mean, I personally, I thought that it was going to go up after Liberation Day because that's what the technical setup said. So I've scrambled and I've fought and I've recovered it and all the rest of it, and it's fine now. But it wasn't pretty or easy or pleasant. So do not for 1 second believe that anyone has sailed through this, because they haven't. If they say they have, they're lying. Simple as that. The best performing thing I've seen in this market is that signal flow model, right? Because it's just gone, I'm out of here. I'm out of the S&P on the 3rd of March, and I'm out of the NASDAQ on the 28th of March. Sorry, 3rd of April for the S&P, 28th of March for the NASDAQ. I'm out of here. That's the best performing investor I've seen, an AI model, right? Any human that tells you that they aced it, they didn't ace it. They're lying.
Got it. Okay.
Ken Griffin didn't ace it, right? Ken Griffin is on stage in Singapore, bleating about how awful it is. So if Ken Griffin didn't ace it, I can tell you most people didn't ace it. So whatever mistakes one might have made, absolutely no point beating yourself up about it. Just go, okay, well, we are where we are. Now what? That's what to do.
Got it. Got it. Yeah. Yeah. A lot of lessons were learned during this thing, at least like
Well, look,
risk management wise.
this is a rehearsal for the real bear market. This isn't, in my opinion, this isn't a real bear market. This is a sell-off that will recover. But it's the commercial for the movies that's to come. And so the movie to come, because I mean, you look at the impact of all of this. Okay, let's talk about the outside world for a moment. Okay, there's some fantastic work on Twitter at the moment about the impact of the China situation. So on the 9th of April, as I understand it, this is all reported wisdom. I obviously haven't verified this independently. 9th of April, trade with China just stopped because it all got too difficult and too expensive. So from the 9th of April, no more exports from China to the US, none. And I'm simplifying for dramatic effect, but let's say none. So after the 9th of April, nothing is on a ship from China. Okay. So some ships are arriving from China right now, and they're unloading in LA and whatnot, and things are going on trucks in LA and going to stores all across the country on those trucks and trains and whatnot. Okay. But that supply of stuff is going to be dwindling soon. And that means there aren't trucking loads to transfer, there aren't rail loads to transfer, and there aren't things on shelves that should be on shelves to be bought and sold. Okay, so that's going to hit the real economy. Even if tomorrow the US and China made nice and everything went back to how it was, even then you've got a one-time sort of moving window of pain that's coming to the US economy. Next, tourism. If you look at the decline in inbound tourism into the US from Europe, it's down dramatically in the last 2 or 3 months, which I don't think is a tariff thing. I think it's a border policy thing. That's going to hit hotels. Southwest Airlines CEO today said, I want to talk about a future recession. We're already in a recession. Southwest Airlines CEO said that. I think it was, I'm not sure if it was at Delta or American, but one of them this week said, we can't give guidance, we don't know. And that's nothing to do with tariffs. That's to do with, again, border policy. So that's going to hit the economy. So these things will hit the economy and will hit the market. But my wild guess is, the market's going to rally in anticipation of better times ahead, in the belief that all the pain is behind it. And then, as always, euphoria will take over, and then reality will hit. And so I don't think this is the start of a bear market. I think it will bounce out of this. I think we'll see new highs in due course. We're not that far below, all-time highs now. But then I think the real bear market will hit. And so if you treat this as a sort of a sandbox for the bear market that is to come, that's probably what to do. And sure, there's some lessons to learn. Everyone's always got lessons to learn from tumultuous market episodes, be they bullish or bearish. But use it to learn, because this is a rehearsal, right? So my takeaway, to be honest, I'm sorry to hark on about a service that we sell, but the fact is it's really good. My takeaway is if I'd listened to the signal flow model, I'd be better off than I am, and I'd be a lot less stressed as well. That's the other thing, which is, my accounts are in reasonable shape, but that's because I've put a lot of heat and light into fixing them. Whereas it would have been better just to go, I'm out of here. Late March, early April, I'm out of here. And then watch things from the sideline with a box of popcorn, which I could have done had I followed the machine. But I thought I was smarter than the machine, which so far it turns out that I'm not. There you go. And again, neither is its creator, which is what I find really fascinating. If you look at the history of all the big quant systems, Renaissance Technologies will tell you that very often, their machine would trade and they'd go, I don't know why it's done that. And then they would try and intervene and do something else, and it would turn out that the machine would be right. So AI is much better at some things than humans already. It's much better at medical imaging analysis. It's better at drug discovery or aspects of it. It's better at solving things like protein folding problems. It might be getting better at material science than humans. It's better than humans at lots of things. And I suspect it's going to get better at investing as well. So that's my lesson.
Got it. Okay. Sounds good. So, got it. So, do you suggest do you suggest keeping stop losses for each and every position of yours, or at least the
No,
major positions?
I haven't, to be honest. I've got I don't think I've got any stop losses in place right now. No, I haven't. So I typically use a stop loss though if it's a swing trade. The single name stocks I've got, I'm going to say ExxonMobil, Chevron, Lockheed Martin, a few of those, which I just bought as a relatively small positions. These are things that are probably good to own if the market goes really, 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 into a tailspin. They're all down a bit, but not much, and they're all stable stocks, most of which pay a dividend. So I don't mind just holding those. I've got TLT and equivalents, USO and equivalents. No stop losses on them. I just let them run.
Oh, God. Okay. Sounds good, Alex. Thank you.
Okay, great, Pressa. Thank you. Thanks a lot. Who's on? Paloma.
Just very quickly, because you mentioned USO, I'm long in an energy fund, okay?
Yep.
But it's called infrastructure, which is a joke because it has Exxon, Chevron, Marathon, Occidental.
Right.
So basically, it's oil companies. I mean, there's no infrastructure in there, and it's completely crashed. And
Yeah.
I am,
It sounds a bit like XLE. It's pretty similar to XLE from the sound of it.
yeah, but I'm just borderline to just get rid of it because, I don't see. First of all, I see a decorrelation between the oil price and the oil company prices. Okay,
Mm-hmm.
so not necessarily because the oil price goes up, the oil companies do well. And I just don't feel comfortable with oil companies right now. I mean, I don't see any catalysts at all. On the contrary, I see them going down further.
What you might be right. I mean, I think so this is XLE on the screen here, which is similar top holdings. Exxon, Chevron dominate it,
Yeah.
and then a bunch of the others. And if you look what happened, there was a sort of there's Liberation Day, which is brilliantly titled right there. And then I think what this says is this goes, oops, if you look back at the COVID crisis. Okay, hang on a second. Here you go. So this is the end of 2019. So if you're paying attention, right, in December 2019, I remember going into doctors' waiting rooms in the UK, and there's being signs everywhere going, if you've been to China or Italy, don't come in here, go home, right? So if you were paying attention, there was something wrong in December. Lots of people were dying in Italy and nobody knew why. Answer, because a lot of people had gone skiing. Anyway, so at this point, energy stocks start to dump because they think the economy is going to stop, right? And, famously USO went negative briefly. And so there's a big dump because it thinks the real economy is going to stop. And then it recovers slowly. And then you get, inflationary bear market, Russian invasion of Ukraine, blah, 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 blah. And that spikes energy. And then I think what you have here, is a sort of similar reaction, which goes, international trade all over, the world's going to stop, bang. And then it's sort of slowly crept up going, oh, well, maybe not. And if you look at oil, USO, And actually oil futures, if you look at West Texas futures, it's even clearer. So just get rid of the moving averages for a second. Look at what happens with oil futures. There's Liberation Day, bang, world's going to end. We go from 71 to 54, in a heartbeat, more or less. And then there's a dawning realization that, maybe the world is going to end and we are going to have international trade again, and it's starting to climb back up again. Hit resistance where there used to be support, rolled over. But I don't mind owning a bit of this. I think, well, we don't, what's not going to happen is we aren't going to go back to, a happily liberalized world of seamless global trade. That's the one thing that isn't going to happen. We are more likely, I would say, to see embargoes of exports and conflict and war and all of that sort of stuff, because everyone's just gotten a bit tetchy and they're not going to get untetchy anytime soon. So I don't mind owning oil and energy in that context, because if we get any sort of rising conflict areas, if we get inflation come back, which one way or the other, tariffs will be inflationary. I don't mind owning a bit of oil and energy. It's not a big holding for me, but I don't mind owning a bit personally. That said, I'm very far from being an expert on these areas. I just view it as a sort of hedge to the predominantly, growth stuff that I own, and I don't mind it personally.
Okay. Thank you, Alex.
That XLE and your infrastructure fund sell off, that's a panic sell, if you ask me. I mean, it doesn't make any sense, right? So that's just that's a oh yikes, right? No one's going to be sailing ships around the world, so you're going to need a lot less energy. So dump. I mean, to go from 94 to 74 in about 4 or 5 days, that's panic. So I think it will climb back up. And then, you know what? For me, if it doesn't, that's all right. I don't mind. It's just a bit of a sort of insurance policy there in case something goes wrong. So I don't mind.
Okay, good.
All right.
Thank you.
Great. Right. We better finish up. We're way over time. So another great session. Thank you. Thanks everyone for attending. As always, fantastic questions. Thank you. If we didn't get to anything, please hit me up in chat. My apologies for the extended sales pitch for stuff that we sell, but if I didn't think it was good, we wouldn't sell it. On the YouTube recording, I'll post 2 links for you to look at. The first link will be to the AI family of services that I mentioned. We offer a 25% discount on those services to anyone who's currently a member of any of our other services. And then also that daily market note service, Market Insights, coming to an end. If you want to sign up for that, do so in April before it closes to new members. I'll put a link and a discount code in there as well. Thanks, everyone. Talk to you all soon.